Today, so where did inflation go? Hello again, it's Martin North from Digital Finance Analytics. Welcome to this post covering finance and property news with a distinctively Australian flavour. The Australian Bureau of Statistics has today released the latest Consumer Price Index for the first quarter of 2021. And guess what? The CPI numbers were way weaker than most analysts and economists were predicting. They actually said that the Consumer Price Index rose just 0.6% in the quarter, and over the 12 months to March 2021, the CPI rose just 1.1%. And within that, the most significant price rise was automotive fuel, up 8.7%, and the most significant price fall was furniture, down 3%. Now, it's worth just noting a couple of things about this particular report. The first is that this included some changes for graduate education, and they're included. And the oil dynamic is also quite significant. In fact, they published a separate article specifically on the automotive fuel CPI. Of course, it's been moving around quite significantly. So overall, this is the chart of CPI. And you can see there 0.6% for March 21. That was considerably weaker than most economists were predicting. Although, of course, I've been arguing for some time that the official CPI number, which of course is not really very accurate, will be understating the reality for many people. But nevertheless, this is the one that the Reserve Bank works to. And so therefore, it sort of confirms the view that they will keep interest rates lower for longer. And in fact, the markets reacted to that thought exactly as I've outlined. So if you look across the capital cities over the quarter, transport at 3.2% was the highest contributor. And over the last year, health costs at 3% and alcohol and tobacco at 7.9% were the two strongest indicators. And communication costs fell 1.9% over the last year, making a CPI movement of 1.1% over the last 12 months. That, of course, is way below the 2 to 3%. And this is the total CPI, not the trimmed mean. We'll come on to that, which is even lower. If we then look across the various categories, you can see how health stands out and transport stands out as the two big contributors. Now, I'm not going to go through all of the detail with regard to the categories, other than to say that food and non-alcoholic beverages were up 0.4%, alcohol and tobacco were up 0.3%, clothing and footwear were up 0.5%, and the housing group was up 0.1%. Now, within that, it's quite interesting to note that maintenance and repair of dwellings rose 1.1% as prices returned to previous levels following the completion of the Northern Territory Government's Home Improvement Scheme. Electricity, they say, fell 0.9%, partially offsetting the rise. And the annual review of Victorian electricity prices drove a fall in Melbourne. Perth rose 41.6% as electricity costs returned to more normal levels following the introduction of the $600 household electricity credit by the Western Australian Government in December 2020. And new dwelling purchases by owner-occupiers fell 0.1%. Now, again, that's a bit of distortion, and they make that point. Home builder and state-based housing construction grants in WA and Tasmania have had a significant impact on the CPI series. New dwellings purchased by owner-occupiers in the March 2021 quarter. The following graph, they said, shows the impact before and after the application of housing construction grants in the CPI. And you can see there that Perth would have been 6.2% compared with 2.8%. Adelaide would have been 3.8 compared with just 0.8. And Darwin would have been 3.1 compared with 1.5. So without the impact of the government grants on new dwelling series, it would have gone up 1.9%, reflecting increases in materials and labour prices in response to strong demand. The large offset from the grants this quarter is due to the substantial increase in the number of payments for Home Builder and the WA and Tasmanian grants. It's expected that those grants will continue to impact the measurement of new dwelling purchases over the next few quarters as applications are finalised and grants are paid. And over the past 12 months, the group fell 1.1%, which is the most significant fall since 1998, and the fall was driven by electricity, down 11.2%, and rents, down 1.4%, the largest annual fall on record for both series. And by the way, in season-adjusted terms, the group fell 0.1%, and that was thanks to electricity down 1.9%. And I just want to make the point that, of course, all of these measurements relating to housing are excluding the cost of the land. There is a sort of a quasi-rental calculation in the CPI. It probably understates the true position substantially, but of course the Reserve Bank lobbied some years ago to remove this particular cost category from the metrics. One reason why CPI is probably understating the true experience of many people, because we know that many people may have had some relief from rents, but if you're trying to buy homes at the moment, prices are rising. Just continuing down the categories, furnishings, household equipment and services were down just 0.2%. The health group was up 2%. And over the past 12 months, the group rose 3%, with medical and hospital services down 4%. And it's worth also noting that there were changes to the pharmaceutical benefits scheme and Medicare this time around. The transport group was up 3.2%. And that obviously was back to automotive fuels, up 8.7%. They actually showed the price of automotive fuels and how it's changed over time. And significantly, the average price of ULP, unleaded petrol, was sitting there at 152. That's the highest it's been, well, since back in March 2020. And that's to do, of course, with the exchange rates and other factors such as the price of oil. The communications group was up 0.5%, and the recreation and culture group was down 0.2%. And that included falls for domestic holiday travel and accommodation, down 1.8% due to airfares. And that was partly driven by the entrance of a new competitor into the capital city markets. And also other recreational, sports and cultural services rose 3.7%. And international holiday travel and accommodation was imputed again this quarter. That's because, of course, there's almost no data on that. The education group was up 0.4%, thanks to changes in secondary education and tertiary education. Insurance and financial services rose 0.1%, with insurance up 0.4%. And it's interesting that I've seen a number of people comment directly on the rises in their insurance premiums way above inflation. Funny that. And the international trade exposures also added, with tradables up 1.1% over the quarter and up 0.7% annually, including, of course, automotive fuels, and non-tradables up 0.4% and 1.3% annualised. Now, they also published a seasonally adjusted analytics series, which includes things like the trimmed mean and weighted mean, which is a stronger indication of underlying inflation. And there, the trimmed mean rose 0.3%, following a rise of 0.4%. And that means that over the last 12 months, the weighted median was 1.3%. That's a revised rise of 1.3 over the 12 months to December 2020. So however you look at it, the RBA continues to undershoot its inflation targeting. And guess what? They've been very consistently undershooting for as long as I can remember. Now, across the capital cities, it's worth noting that Sydney was only 0.4, whereas Darwin was 2.6, Canberra was 0.9, and Hobart was 0.8, with Perth at 1.4. And you can also see there both the percentage changes in terms of the quarter and also annualized. I'm interested to see that Darwin is at the top of the list in terms of cost rises. Perth, of course, also is doing quite strongly, along with Brisbane on an analysed basis, but Sydney and Melbourne are actually weakest. And then they called out some of those highlights. So in Sydney, up 0.4%, automotive fuel at 8.6%, medical and hospital services and new dwellings purchased by owner-occupiers were down a little, and the annual rise was 0.9%. In Melbourne, again, automotive fuels at 7.8%, pharmaceutical products at 5.9%, electricity at 8.7% down due to the annual review of electricity prices, and that gives you an annual rise of 0.8%. That's the weakest of all the capital cities. In Brisbane, fuel was up 7.7%, medical and hospital services up 1.9%, new dealings purchased by owner-occupiers down 1.1%, and that makes a 1.7% annual rise. Adelaide had a 15.1% rise in automotive fuel, which is the most significant price rise of all the capital cities, coming off a large price fall last quarter. Pharmaceuticals were up 4.2%. New dwellings purchased by owner-occupiers was up 0.8%. Holiday travel was down 3.3%, and that gives an annual rise of 1.2%. Perth had a rise of 41.6% in electricity due to the majority of households having used most of the WA government $600 credit last quarter. And so electricity costs have returned to more normal levels this quarter. Automotive fuel up 9.6%. New dwellings purchased by owner-occupiers up 2.8% due to material and labour price rises in response to strong demand, which was partially offset by the home builder and WA construction grants, and that gave Perth an annual rise of 1%. Hobart was up 0.8% with automotive fuel up 6.6%, secondary education up 13.1%, and preschool and primary education up 14.2% due to fees returning to previous levels after the Tasmanian government refunded all compulsory public school levies paid in 2020. That gave an annual 1.1% rise in Hobart. Darwin was up 2.6%, which was the strongest rise in all capital cities, with maintenance and repairs of dwellings up 101.9% due to prices returning to previous levels following the completion of the Northern Territory Government's Home Improvement Scheme. Automotive fuel up 8.1%, secondary education up 6.2%, and Darwin recorded an annual rise of 2.3%. That's the strongest of all capital cities. And Canberra was up 0.9%, with automotive fuel up 6.6%, medical and hospital services up 2.4%, secondary education up 4.8%, and that makes Canberra recording an annual rise of 1.6%. And here is the quarterly percentage change by capital city. So what does this all mean? Well, I think there are three observations. The first is that the underlying level of inflation remains still stubbornly low. And whilst we can have discussions about whether the CPI metric is measured right, it's not. Nevertheless, this is the way that the RBA is going to determine when it's going to lift interest rates. So the second point is interest rates are going to stay low for long, in line with RBA discussions. Now, that doesn't mean necessarily that funding costs of the banks are going to stay as low, so we may see some out-of-cycle price rises for mortgages later, particularly some fixed rates. The third point I make is that there's still a lot of noise in these numbers, thanks to government schemes that were put together last year to support the country and state level, thanks to the COVID response. They are being withdrawn, of course, now. And so they are having a significant impact, because if you go from a very low point to a higher point, that tends to have a bigger impact on the numbers than it would normally be the case. So we should be a little bit cautious in terms of concluding too much from this, but I have to say that I think the inflation dragon is still firmly sleeping. And that says to me that all of this hype about the expectation of inflation running through the roof, and by the way, a lot of people in the US have been talking about this, as I discussed yesterday in my live show with Damien Klassen, as a chart which I'll show now, which reveals what happened to the inflation discussion as part of the results season in the US. And there was a huge uptick in the number of people talking about inflation. But it may well be that the truth is that inflation remains stagnant and that we are still potentially facing into a more deflationary rather than inflationary future. If that is true, it means that precautions that you might want to take to protect your financial position could be quite different from those in a deeply inflationary environment. That's why people should be a bit cautious. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.